So moving right along from hedge funds, I wanted to talk a little bit about this article here. It says Staten Island mastermind of $20 million boiler room scam gets 8 years in prison. Now, this sentence was handed down just a few months ago. This is a story of Kenneth Marsh and Gryphon Holdings. This is basically an investment company that scammed $20 million from 5,400 investors in the U.S. and internationally. It says some clients lost their life savings with Marsh's company. 2 even contemplated suicide, according to court papers. So what these guys did, this was actually very outrageous. What they did was they didn't even open a fund or open an investment company. They weren't even an investment advisor. They just decided to call people on the phone and pitch them investment advice, for which they would charge anywhere from $99 to $250,000. It sounds unbelievable. This story really takes the cake when you look at it, as far as just the sheer audacity of these individuals to do what they did. And also, unfortunately, it also outlines the gullibility of a lot of investors out there who, in all honesty, they just want a solid return. But according to some of the promises that this company was making, I mean, it really should have been apparent that something illegitimate was going on. But when investors are pitched something on the phone and they get the hard sell, they tend to go for it, unfortunately. So it says here, posing as a high-flying executive, Marsh masterminded a devastating fraud scheme out of a Travis strip mall, which is a neighborhood here on Staten Island, that convinced financial advisors, insurance salesmen, retired doctors, and educators and other seemingly canny professionals to put their hard-earned money in this bogus hedge fund. These people claimed to run a $1.4 billion hedge fund that simply did not exist. It says one client, a 72-year-old Kentucky ophthalmologist, lost more than $700,000. This person had substantial health problems, was hoping to grow his $1.1 million life savings to provide for the care of his permanently disabled son. You know, $700,000 hit is definitely going to take a bite out of that. There's no doubt about it. So it goes on to say that these investors basically are not going to see any of this money back because it's not insured and there's no guarantee of having any return. So in situations like this, when it's a complete scam, there are no investments being made, the likelihood of recovering money is slim to none. And unfortunately, investors don't really have a leg to stand on. The money could all be gone, essentially. There's really nothing stopping this from happening. And really, what gets me about this story, and I haven't seen it covered in the news all that much, it's just, like I said before, the sheer audacity of these people simply amazes me. And I have actually the court documents here. I have the complaint, and it speaks for itself. It says, to further portray themselves as investment experts in the trading of stocks and options, and to mislead existing and prospective clients that they, too, would have extraordinary profits if they paid fees for Gryphon's investment recommendations, the defendants falsely represented that Gryphon managed a hedge fund with holdings in excess of $1.4 billion, as mentioned earlier. In truth, Gryphon did not operate, manage, or advise any hedge fund, let alone one with over $1 billion under management. In conversations with clients, Gryphon representatives frequently referred to self-made millionaires or billionaires, Michael Warren or Kenneth Maseka, as the firm's chief traders. One little problem, though, these were figments of Kenneth Marsh's imagination. These people didn't exist. As a result of the defendant's fraudulent scheme, Gryphon obtained over $17.5 million since at least 2007. $17.5 million. The fraud intensified in recent years, with Gryphon obtaining approximately $9.6 million in 2009 alone and $3 million in the first 2 months of 2010. Gryphon clients who had paid fees ranging up to $250,000 to obtain Gryphon's investment advisory services often suffered additional losses by trading at Gryphon's direction or based on their investment recommendations. So those $250,000, that would be a client paying for a piece of advice, and then actually acting on the advice, they would lose even more money. Now, this becomes really surprising given the fact that the methods used by these guys were not even very sophisticated. They were just very high pressure, and it just goes to show that these clients, had they even looked whether Gryphon was an investment advisor, they would have had to stop dead in their tracks because the firm basically did not exist, was not registered at all, and a 10-minute search on the internet would have easily led these investors to find that out. It says, Gryphon markets itself as a publisher of financial newsletters and solicits subscribers to purchase its publications. Gryphon's publications in reality served as a vehicle to attract clients to pay additional fees for premium services that include investment tips and recommendation, portfolio analysis, and investment management. It goes on to say that neither the company or its defendants were registered with the SEC. And these newsletters had terrific names: 6 a.m. Money Machine, Raging Bull, Wolves of Wall Street, Wall Street's Most Wanted, Put Play of the Day, Pure Profit, Wolf Option Trader VIP. I mean, it's just perfectly legitimate sounding, of course. Mafia Trader is another one they had. And once a client pays Gryphon for one or more of these advisory services, the representatives would provide the client with more high-pressure tactics to sell them even more nonsense over the phone. Now, this happens in every single industry. There's always a few bad apples, but what I'm really trying to point out here is that investors really need to start taking responsibility for this, because in all honesty, these guys didn't even try. They just didn't even try. And for investors to buy into such a scheme, it's even different from Madoff, because Madoff had at least a long-term reputation. He was registered as an investment advisor. So the clients in that respect would have more trouble filtering through exactly what was going on, although this should be more transparent than the Madoff situation by far. But again, investors always fail to look, and this is an example of what can happen. It says, Gryphon's fraudulent scheme was not limited to material misstatements and aggressive high-pressure sales tactics. In 2008, defendant Kenneth Marsh, pretending to be Michael Warren, induced a Gryphon client to provide him with authority to trade for the client's benefit in the client's Fidelity brokerage accounts. Warren purportedly agreed to trade for the client's benefit pursuant to an agreement where Warren, quote unquote, which this person didn't exist, let's keep in mind, would retain 20% of profits, and the client would pay Warren a $50,000 management fee, which is absolutely unheard of, to pay a fee up front to that amount. The client paid Gryphon $50,000 by a check. The client noticed that Warren traded for more than 60 days but was losing money, and the client terminated the trading authority. And on a separate occasion, one of these guys solicited the same client to provide $100,000 to quote-unquote Warren for investment in a special type of investment vehicle. The client was advised that Warren was able to give a similarly situated client a return of 1,600%, and that the client would expect the return of principal within 2 or 3 years. So hearing this, after this person put in $50,000 by check, having lost money, being promised 1,600% returns, which is absolutely ridiculous, decided to provide yet another $100,000 to these people. Now, on one end, of course, I'm absolutely demonizing these guys and what they did, but the clients have to be more careful. It's reckless. People are being reckless with their life savings. A lot of these cases you hear, FINRA charged so-and-so firm, or FINRA fined so-and-so firm, but you never really get down to the details like this. And I wish the news did this more, because I think investors would be more aware of what exactly to look for. And the more I read this particular case, the more I'm just blown away. On its website, Gryphon promised clients that it would, quote, stuff your pockets with more cash than you thought possible. Keep in mind also that these people's command of spelling and grammar are also pretty weak, as these quotes point out. So you're being promised 1,500% returns by people who can't really spell. It's just astonishing. They also boasted that its connections on the street allowed it access to more information than the average investor would hear in 100 lifetimes. This is a quote. Okay. Gryphon's website also falsely stated that the firm provided services to, quote, the top 1% of the wealth from around the globe, and claimed the Gryphon clients obtained remarkable gains of 1,500% and 2,400% buying calls prior to some of the biggest mergers, whatever, on Wall Street. And even further, I mean, this is where this story gets slightly comedic, even though it's very, very somber indeed. It says the longest string of winning trades ever known to man. It's another claim that was made. 1,300% returns in the last few years. In the last 16 years, it says, even though the company was formed in 2005. So clearly, doing the due diligence on this would not be too difficult, given the fact that the company did not exist when they claimed to have these sort of returns. Website also stated that the trading tactics can turn 5,000 to 250,000 in just 6 weeks, and so on and so forth. So I think the story speaks for itself and is a prime example of exactly what happens, and also the effects of being gullible in these sort of market conditions. It's just the same things happen over and over, and it just never ends. The thing that people really don't get to see are the people's reactions that have been affected by these sort of situations. Part of these court documents detail some of the reactions from the victims. It says, Gryphon took my retirement money, and now I have serious doubts that I'll ever be able to retire. I'm 59 years old, and I don't have enough time to make this money loss up. I fear for my family's well-being in the future. Prior to the crime, my financial house was in order, and I had plenty of money for retirement. Now I have to start over. That was another quote there. So it goes on to say, one victim stated that his wife of 28 years left him soon after he admitted that the defendant's scheme had caused him to go $125,000 into debt, $100,000 of which resulted from fees and failed trades. And again, people have to be careful, especially in doing the due diligence. A lot of people may not be experts in looking up companies or looking up investment advisors, which is fine. You know, they don't really teach this in school necessarily. But the important thing to remember is if people have an accountant they work with, then that person may have some kind of experience, and that's somewhere they can definitely turn to get some due diligence done. Because when people hear about these wonderful returns, 1,300, 1,600%, people tend to forget, well, what if this is a complete scam? They want to get the returns. They want to hope that this is the one, that they found the secret to success in the market, and we can see how that turns out. So unfortunately, there are more stories like it.